Okay, so you want to run a market stall. Buy some stock, hire a pitch in the local market square, set up a trestle table and a gazebo, and watch the Saturday shoppers hand over their cash all day long. That is the plan in your head. And it looks like one of the lowest barrier businesses in the entire country. Walk through a busy British market on a Saturday morning, and it genuinely does look easy. Stalls packed together, shoppers browsing, cash and card machines both going constantly. The smell of fresh bread and street food drifting between the rows. You watch that scene and you think, this must be a brilliant low-cost way to make a living. No rent, no lease, just turn up and sell. Here is the problem. You are looking at the one morning of the week that lies to you the most. The truth is that a market stall is not really a low-cost business. It is a business with almost none of the protection a shop has, and every single risk concentrated into just a handful of trading hours a week. And the moment you understand that difference, everything about how a market stall makes money and how it quietly fails starts to make sense. Let us start with what it actually costs to get going. Because the popular image of a market stall as a nearly free way into self-employment is genuinely misleading. There is not one type of market stall in Britain. There are several, and each one is really a different business wearing the same folding table. At the bottom end, you have the casual or occasional trader. Someone doing a handful of car boot sales or one-off craft fairs a month, often turning over just a few £1,000s a year, treating it as a genuine side income rather than a full-time living. Above that sits the regular market trader, someone with a fixed weekly pitch at one or two established markets, typically turning over somewhere between £15,000 and £60,000 a year, depending on the category of goods and the strength of the specific market. Above that, the multi-pitch trader, someone who has built up several stalls across different markets and different days of the week, sometimes employing a small team to run pitches they cannot personally staff at the same time, which can push annual turnover well into 6 figures. And then there is the seasonal specialist, someone built almost entirely around Christmas markets, food festivals, and other short-term event pitches, who might earn the majority of their entire year's income across a genuinely small number of concentrated trading weeks. Each of these is a different bet on the same underlying question. Do you build a stable weekly routine at a small number of reliable pitches? Or do you chase the biggest concentrated opportunities wherever and whenever they appear? That single decision shapes almost every other number in the business. Now here is where the naive mental model starts to break down. You think the expensive part is the stock. It is not, or at least it is only part of the story. A daily or weekly pitch fee at a council-run market can range from as little as £10 a day at a quieter local market, up to well over £100 a day at a prime pitch in a busy town center or a well-known destination market. And that fee is due whether you sell a single item that day or you sell out completely. On top of the pitch fee itself sits the physical kit needed to actually trade. A proper gazebo or stall structure robust enough to survive genuine British weather. Weighted down correctly because market authorities can and do fine or eject traders whose stalls are not properly secured against wind, typically costing several hundred to over £1,000 for something built to last. Then comes a van or vehicle capable of transporting stock and equipment to and from the pitch every single trading day, which for many traders becomes one of the largest ongoing costs in the entire business, once fuel, insurance, and maintenance are included. Add public liability insurance, which many market operators now require as a condition of trading and which typically costs a few £100s a year. A card payment machine and the transaction fees that come with it. Appropriate food hygiene certification and equipment if selling anything edible. and an initial stock purchase large enough to actually fill a stall attractively rather than looking sparse. And even a modest single-pitch trading operation can require £2,000 to £15,000 just to get properly set up, well before the true cost of restocking week after week is factored in. So far, so good. Now let us talk about what can go wrong. And the single biggest trap here is one that a shop owner simply does not face in anything like the same way. The weather. A shop with 4 walls and a roof trades at essentially the same footfall on a wet Tuesday as it does on a sunny one. Customers simply walk in from the rain. A market stall has no such protection. Genuinely poor weather, heavy rain, high winds, or a cold snap can reduce footfall at an open-air market by a significant margin on any given day. And because the pitch fee, the fuel to get there, and the trader's own time have all already been spent before a single customer walks past, a rained-off Saturday is not simply a quieter day. It is very often a straightforwardly loss-making one. This is not a rare, occasional disruption either. British weather across a full trading year genuinely does deliver a meaningful number of days, poor enough to significantly suppress footfall. And unlike almost any other retail business, the market trader has essentially no way to hedge against this risk beyond choosing to not turn up at all on the worst days, which simply converts a bad trading day into a guaranteed zero trading day instead. Now, the second major trap sitting alongside the weather is perishability and unsold stock. And this hits certain categories of trader far harder than others. A trader selling fresh food, flowers, or anything with a genuinely short shelf life faces a brutal daily reality. Unsold stock at the end of trading is very often unsold stock that has to be discounted heavily, given away, or simply thrown away, because it will not survive to be sold at next week's market in the same condition. A trader selling clothing, homeware, or crafts has more flexibility. Unsold stock can simply be repacked and brought back the following week. But that trader faces a different version of the same underlying problem. Capital tied up in stock that is not moving, sitting in a van or a storage unit, rather than generating any income at all. Both versions of this problem punish the same mistake: misjudging demand and buying too much stock for a given week. And both versions can quietly erode a trader's margin in a way that is much harder to spot in the moment than it would be for a shop with a proper stock management system and a longer selling window to correct course. Now, location within the market itself matters enormously. And this is the decision most new traders underestimate, because they assume any pitch inside a busy market will do reasonably well. It is more specific than that. Pitches near the main entrance, near a popular anchor stall like a well-known bakery or butcher, or along the primary footfall route through the market, can see dramatically higher passing trade than a pitch tucked away at the edge or in a side row, even within the exact same market on the exact same day. Established markets typically allocate their best pitches to their longest standing, most reliable traders, which means a new trader often has to accept a genuinely weaker pitch position for months or years before earning the seniority to move somewhere better. And that positioning gap alone can be the difference between a pitch that comfortably covers its fee and one that barely breaks even. Now we get to the part of this business that actually explains everything else, and it is the decline of the traditional British market itself as a shopping destination. Picture 2 very different customers walking through a market on a Saturday. One is there specifically because they have always shopped at this market, perhaps for decades. And market day is as much a social routine and a habit as it is a shopping trip. The other is younger, has grown up doing the majority of their weekly shopping either at a supermarket or online, and is at the market almost by accident, perhaps drawn in by a specific food stall or a craft fair event rather than as part of a regular weekly routine. British market trader numbers and overall market footfall have declined significantly over recent decades, driven by exactly this generational shift in shopping habits, alongside the growth of supermarkets and online retail. And the traders who have survived and thrived within this declining overall picture have overwhelmingly been the ones who have adapted what they sell and how they present it, leaning into genuinely differentiated, hard-to-replicate products, specialist food, craft goods, vintage items, rather than competing head-on with a supermarket or discount retailer on price for a mass-market product that customers can now buy more conveniently elsewhere. There is a seasonal wrinkle to this whole picture too, and it shapes the entire calendar of a British market trader in a way that is even more extreme than in most other retail sectors. Christmas markets, in particular, have become one of the single biggest opportunities in the entire trading calendar for many stallholders, with some traders earning a genuinely disproportionate share of their entire annual income across just the few weeks of the November and December Christmas market season. This creates a genuine feast and famine rhythm, not entirely unlike a seaside hotel's summer season, except compressed into an even shorter window. And traders who plan carefully around this, securing the best Christmas market pitches well in advance, and stocking appropriately for the surge in demand, can transform their entire year's financial picture around that single concentrated period. Traders who miss out on a good Christmas pitch, or who misjudge how much stock to bring for it, can find the rest of their trading year considerably harder to make work financially as a result. There is also a structural choice sitting underneath all of this, which is whether to build a business around a single loyal weekly pitch, or to diversify across multiple markets and event types to smooth out the inherent unpredictability of any single location. A trader committed to one weekly pitch builds genuine local reputation and repeat custom over time. Regular customers who know exactly where to find them every single week. But that trader is also fully exposed to whatever happens to that one specific market. A decline in its overall footfall, a change in its management, or a run of bad weather on that particular day of the week. A trader who diversifies across several markets and events reduces their dependence on any single location's fortunes, but takes on significantly more logistical complexity, more travel, more setup and pack-down time, and a genuinely harder time building the kind of deep, loyal, weekly customer relationship that a single fixed pitch can develop over years. Now, here is where the financial fragility becomes just as important as a busy Saturday morning looks. Why do so many market traders, people who have clearly built real skill and a genuine following at their pitch, still struggle to make the numbers work across a full year? The pattern is genuinely structural. A trader can have an excellent, well-attended stall on a beautiful Saturday in June, and the exact same stock, the exact same skill, and the exact same effort on a wet, cold Tuesday in February. And the difference in the day's takings can be enormous. While the pitch fee, the fuel, and the trader's own time cost roughly the same either way. Unlike a shop that can spread its fixed costs across every single trading day of the year with reasonable consistency, a market trader's income genuinely swings on the weather, the season, and the specific footfall pattern of their specific pitch, in a way that makes budgeting and cash flow planning considerably harder than it looks from the outside on a good day. So how does a market stall actually make money in plain mechanical terms once you strip away the image of a busy Saturday morning? The core engine is simple. Average spend per customer, multiplied by the number of customers who actually stop at the stall, minus the cost of the stock sold, minus the pitch fee, minus fuel and vehicle costs, minus insurance and any other fixed overheads. If a trader pays £60 a day for their pitch, spends £20 on fuel getting there and back, and makes an average margin of £8 on every item sold after the cost of stock, they need to sell roughly 10 items just to cover that single day's fixed costs before making any profit at all. On a strong Saturday with heavy footfall, that target might be reached within the first hour of trading, with the rest of the day almost pure profit. On a quiet, wet Tuesday at a smaller market, that same target might never be reached at all, and the trader has effectively paid to stand outside for a full day. This is the volatility that defines the entire sector, and it is precisely why experienced traders talk about their income in terms of an average across a full month or a full season, rather than judging any single day's takings in isolation, because a single bad day tells you almost nothing reliable about the underlying health of the business. Now let us put all of this together and look at what actually happens over a full year, because this is where the two very different versions of this business reveal themselves. In the optimistic scenario, you have secured a genuinely strong pitch at a market with healthy, consistent footfall, built up a loyal weekly customer base who seek you out specifically, chosen a product category that is not easily replaced by a supermarket or an online competitor, managed your stock carefully enough to minimize waste and unsold inventory, and made the most of the concentrated Christmas market opportunity each year. Under those conditions, a committed market trader can build a genuinely stable, modest, but reliable full-time income, with the flexibility and independence of self-employment as a real, tangible benefit alongside the money itself. In the realistic scenario, 2 or 3 things go wrong that are not exotic at all. They are the normal risks of this exact business. A run of poor weather across several consecutive Saturdays significantly suppresses footfall right when the trader was counting on strong weekend trade to cover the week's costs. A nearby supermarket or new online competitor undercuts the price of the trader's core product, forcing a difficult choice between matching the price and accepting a thinner margin, or holding the price and accepting fewer sales. A pitch position shifts unfavorably when the market reorganizes its layout, moving the trader further from the main footfall route through no fault of their own. Under those conditions, that same trader can slide from a comfortable, sustainable income into a genuinely precarious one, even while the market itself still looks busy and successful from the outside on any given weekend. And almost none of that swing shows up as a single dramatic event. No closure notice, no scandal. Just a slightly wetter run of Saturdays, a slightly cheaper competitor down the road, and a slightly worse pitch position, compounding quietly week after week, until the trader's own bank balance looks nothing like the busy market square would suggest. So if you do decide to become a market trader in Britain, remember the one thing that actually determines whether you survive. It was never really about how busy the market looks on the best possible Saturday. It is about how well you can survive the ordinary, unremarkable Tuesday, in the rain, when nobody is watching, and the till stays quiet all day. If this kind of breakdown helps you see a business differently, that is exactly what this channel is built around. Subscribe to Money Framework British for more deep dives into how everyday businesses really make their money behind the scenes, and turn on notifications so you never miss the next